Israel launched strikes on Beirut. Meanwhile, Iran said that Tehran will deliver a painful response to Israeli strike. At the same time, Trump continues to give mixed statement. At one point, he is saying that they are close to an Iran deal with two minor points outstanding, but at the same time, he is warning of a military action against Iran if no deal is reached. On the other hand, US economic data and US labor market data continues to surprise the market participants. On Friday, we received the NFP numbers and they came in with a big surprise. At the same time, unemployment rate remains steady at 4.3%. In this video, we will be going through each and everything, the recent economic data, the Middle East situation. We will do a sentimental analysis, fundamental analysis, technical analysis. We will go through different markets like gold, indices, Bitcoin, oil, each and everything, and we will plan our trades for the upcoming week. So without any further ado, let's just start. If we see the general market sentiment right now, we are in a risk off mode. We are not in a kind of a risk aversion type of mode or in a panic selling type of mode, but at least still we are in a defensive positioning mode where investors are skeptical. And this is mainly driven by obviously a strong US jobs data, as it is causing the rate hike bets stay alive and the higher for longer bets stay alive as well. We are expecting hawkish Fed and the US and Iran war, the dollar surging, all of this, it is putting the pressure on the markets. It is putting pressure on the precious metal, it is putting pressure on the indices market as well. And we can see in the last few days, especially on the NFP day, we saw a continued surge in the dollar prices. And again, it was mainly driven as the Fed is expected to rise the interest rates due to an overall strong labor market, due to the rising oil prices, rising inflation expectations. And we can see the impact of all of this in the yield market as well. The 10-year yield have been rising. They are back at the critical level or a little higher of the critical level, which is the 4.5 level. And at the same time, if we see the 2-year yields as well, they have been rising continuously as well. The markets, the yield markets, the bond markets, they are aggressively pricing in higher for longer or even rate hikes going into the future. And we can clearly see the impact of it on the other markets. We can see the impact of that on indices as well. With the stronger jobs report, we saw a kind of a profit taking move on the SPX. We saw a brutal profit taking in the Nasdaq, in the Dow Jones, and we are seeing some brutal downside in that Bitcoin as well. On the other hand, we can see precious metals like gold, like silver, they saw a brutal hit too. Gold was trading on this higher time frame daily channel, but on Friday with that strong jobs report, gold broke lower. But now the question is, what is coming next? Are we really going to see some upside in gold, or this is the over of the bull run for gold and gold is going to continue moving lower? About the indices as well, if this is the end, if the indices are going to crash now, or are we going to see a pullback, are we going to see this turning into another dip buying opportunity? And at the same time, we need to talk about the dollar strength, we need to talk about the pullback or the profit taking in oil as well. Is it a trap, or oil is actually heading lower all the way back to the pre-war prices of $65 per ounce, per barrel, or maybe even at least $75 per barrel level? Or if oil prices are going at $150 per barrel level? These are the main questions. And based on my expectations, based on my thesis, I would say that for me, gold still remains bullish. Like, this may sound a dumb take, but if you see on the technical side, this was the first close for gold below the 200-day moving average after months. And technically, this is, yes, indeed a bearish signal. But there is one more thing. The thing is that about the real yields, gold is not a trade of, you can say, interest rates, of inflation expectations. Gold is a real yields trade. Now, those who don't know about real yields or how they impact gold, let me tell you in a very simple way that when the real yields are rising, when this chart is moving higher, it means that investors are getting more return from buying bonds. They are outpacing the impact of inflation. It will mean that for investors, if they buy a bond, it is more attractive to them to buy bonds than to buy gold. In a very simple way, if the real yields are rising, it will mean that the opportunity cost to hold gold is increasing. That is why at that time investors will simply ditch gold. They won't buy gold and they will simply invest in the bond market. They will simply buy bonds, right? But on the other hand, if this chart is declining, then it means that the opportunity cost to hold gold is becoming more attractive to the investors than of holding the bonds or than of buying the bonds. That is why at that time investors will ditch bonds and or other assets, and they will go and buy the safe haven, which is gold. Okay, and if we see in the past few days, we have obviously seen oil prices still elevated. We are still seeing rising inflation expectations. We are still seeing, and overall, you can say in the short term, you can say, I would say, I would tell you why I'm saying in the short term, but only in the short term, you are seeing kind of a strong labor market picture, right? But still, the real yields, the 10-year break-even inflation rate is still declining. On the other hand, if you see the 10-year bond yields, they are rising recently. The real yields, they have been moving lower, while the bond yields, the 10-year bond yields, they are moving higher, right? So in my view, based on the real yields chart, this market is not pricing in higher inflation expectations. This market is pricing in something very brutal. This market is pricing in maybe a recession, right? This market is not pricing in, at least for now, based on the real yield chart. This market is not pricing in higher interest rates. Okay, based on the real yield chart, based on the participants or the expectations of the participants in the bond market, right? If they were if they were pricing in higher interest rates and everything to remain normal, like the job market situation, like the economy, everything to go smooth, to remain strong, then this chart would have been right now rising as well. But what we are seeing a decline in the real yields. That is why the opportunity cost, to me at least, for holding gold is becoming more attractive. And there is one more thing. This year we have the midterms in the United States. Midterm will simply mean that political uncertainty is around the corner. And whenever there is political uncertainty, whenever the political uncertainty rises, especially in the United States, investors rush and they go and buy gold. They ditch the indices, they ditch Bitcoin, they ditch everything, they ditch even the dollar as well, and they ditch the bonds as well. Because when the political uncertainty is coming directly from the United States, you can't go and invest in any asset which is directly linked to the policies of the United States, because that is what the uncertainty is all about. Okay, the political uncertainty only rises because of the midterms, because you don't know the results, you don't know how it will impact the future policies, right? That is why you ditch all the assets related to that country and you go and invest in some safe haven asset, which is obviously going to be gold. In this case, you can't invest in dollar as well, because the uncertainty is coming from the dollar reserve country itself, right? That is exactly why midterms political uncertainty, it is bullish for gold. And at the same time, obviously, I told you the real yields part, the real yields have been declining, and it is again in turn a bullish signal for gold, right? And there is one more thing from a sentimental perspective. If you see Trump is a person who has said multiple times that he does not want to see interest rates moving higher. He simply wants to see interest rates moving lower. He is bringing in insane liquidity in the financial markets by doing tax cuts, by doing income cuts, and at the same time he is demanding lower interest rates. He will put pressure on Fed. He will do each and everything like this. And the hedge funds, the institutions, the countries, the China or India, all of them, they know that. And that is exactly why they have been continuously accumulating gold, more and more gold. The weak hands in all of this time, they have been continuously selling gold. But countries, central banks, hedge funds, they have been continuously accumulating gold in all of this profit taking move, in all of this higher time frame consolidation or accumulation, whatever you want to say. They are still expecting higher prices. Why? Again, because of political uncertainty, real yields have been declining. Hedge funds are still bullish because they don't see fiat currency doing well going into the future, and they don't see the global economies in a shape to tackle higher interest rates. Okay, they don't see the global economies or the economies of the United States right now, or the labor market from an overall, from a broader view picture. They don't see it in a shape to adjust with higher interest rates. If you do higher interest rates, if you aggressively rise the interest rates, then the labor market right now or the global economies right now, I would say, they are not in a strong picture to adjust the impact of higher interest rates. They can probably go into a recession. You can literally destroy economies by aggressively hiking the interest rates. They will need to wait. Right now, all of these markets, whether it's the indices, whether it's gold, whether it's the dollar, whether it's the bond market, they are pricing in higher interest rates. And in my opinion, they are overpricing it, right? These expectations will get faded away soon. I believe maybe by the next quarter, by Q3, these expectations will get faded away, right? Overall, I still stay bullish on gold, but for now, in the short term, we can very well see with the recent escalations, with the recent Middle East escalations, with the recent Israel strikes on Beirut, and with Iran saying that they are going to respond, and with the stalemate between the US and Iran negotiations, and with the recent, in the short term, a strong labor market picture, we can still see some continuation in gold to the downside before it starts to rise, right? We can very well test this demand area on the daily time frame around the 4200 round levels, psychological levels, or we can even test this demand area on the daily time frame around the $3900 levels, 3950, something like that, before we start the grind higher. Overall, the macro bullish picture for gold, or the medium to long term bullish picture for gold, has still not changed. It remains very bullish. But specifically again for the next week, I am expecting gold. Obviously, I'm expecting a little bit of continuation of gold to the downside, maybe until 4250s, or till the flat $4200 levels, before we see an intraday type of pullback, a kind of a profit taking move by the sellers, which will obviously inch the gold prices higher. And in that case, we can very well test this area around the 4480s, 4440s, something like that, from 4200s flat. Now, why I'm expecting this? I am expecting this based on a likely yen intervention. Now, if you don't know this, I will put this again in a very simple words. Let we go first on the weekly time frame. It will be a more clear picture. Now, what I mean by yen intervention, I mean this, I mean this, I mean this, and I mean this. Now, there are many other examples as well, but for now, we will reference to these points only. All of these downside moves, they come from this critical level of 160, 162, somewhere in between this, okay, or somewhere near this, okay. What what happens actually, that the Bank of Japan, they intervene in the financial markets. What they actually do, they sell the US dollar and they sell the US treasuries. Okay, they sell it aggressively so it can make the yen stronger against the dollar. Obviously, it happens only in the short term. You only see some short term impacts which get faded away eventually, like here, like here, like here, and like here as well. But this 160 handle and the zone between, you can say, the 160 and the 161 handle, it is going to be very important. And the Bank of Japan chairman, they have been continuously talking about that we can very well intervene in the financial markets if we need to do that. And I believe that with this handle becoming more and more near again, okay, we have seen continued yen interventions, continued small yen interventions, but now we are expecting a big yen intervention going into the next week, right? And at the same time, I was referring it to gold, I remember. If we see a yen intervention, what they will do, in simple words, they will sell the dollar and they will very likely sell the US treasuries as well. And that will have a negative impact on the dollar, obviously, a negative impact on the US treasuries. It will have a positive impact on the yen, and ultimately a negative impact on the USDJPY, because it will obviously reduce the strength in the dollar and it will increase the strength in the Japanese yen, right? And at the same time, as it is reducing the strength in the dollar, as it means selling of the US treasuries, then it will give short term strength to the gold as well. Like, for example, if we come here again, and if we see the date of this yen intervention, it came on April 27, 2026. If we go on the chart of gold and come all the way to that date, which is April 27, sorry, we will need to go on the daily time frame to get the exact date. Let me just get it on the daily time frame. And on the yen, this was the intervention. It was on 30th April 2026. Okay, so if we come here again and see the price action of gold on 30th April 2026, we can see that this was the April 30th candle, April 30th 2026. We saw the yen intervention, we saw the dollar getting weakened, we saw the selling of the US treasuries as well, obviously because the Bank of Japan intervened in the financial markets, and we saw a positive impact of that in the gold prices, right? That is exactly why, that is how you can say ultimately a yen intervention will push the USD JPY lower, it will push the DXY lower, and at the same time it will push the gold prices higher as well. So with the likely yen intervention going into the next week, as we are becoming more and more near to this handle of 160, between 161, something like that, a yen intervention is becoming very likely. So now you have two trades based on sentiment and based on fundamentals. One is going to be USDJPY shorts, and the second is going to be gold longs aligned with that. Now, obviously, you can take either one of them or you can take both of them. It depends on your risk management. It depends how much of the exposure you want to the markets based on one trade idea or based on one trade sentiment or based on, you can say, an assumption. You can say eventually it is an assumption, but a lot of data backs this. Okay, a lot of data is backing this narrative, is backing this idea, and a yen intervention will eventually come. If we again go onto the monthly time frame, see, have you ever gone higher? No. Whenever you come near to this handle, you get multiple, every time you get a yen intervention because they simply cannot see the yen breaking this. And surprisingly, this yen intervention comes in with the coordination of the United States, right? So again, we can see a brutal yen intervention which will push obviously the USD JPY lower, and at the same time, it will push the gold prices higher as well. But again, from a near term perspective, from the first half of the week, I'm not expecting any type of yen intervention in the first half of the week. We have the CPI data, we have the PPI data, so most probably they will wait at least for the outcome of the CPI data. Maybe they will wait until Wednesday before they intervene. No, obviously it is not necessary, they can intervene earlier than that as well, because again they are going to coordinate with the US. They can intervene earlier than that as well. And just to clear it, that this is not a sell limit and this is not my stop loss and this is not my take profit. This is just for representation. I may take a entry at the early market open, maybe here, maybe here, maybe here, maybe here. You never know. Okay, this is just for representation. By the way, what I was saying was that you never know when they are going to intervene, but more than likely they will intervene by Wednesday. Okay, so I'm prepared for that. I'm looking for some yen shorts at this level, and at the same time, due to the recent escalations, due to the recent strong jobs market and everything going on with the financial markets right now, which I just explained to you earlier, I believe we can see a bit more downside in gold before we see that impact of the yen intervention, or before we see a profit taking by sellers, which will eventually push gold prices a little bit higher. Now, why I want to buy when this chart is screaming to sell, I want to buy or I want to target pullbacks eventually, because my medium to long term bias is still bullish on gold. I don't see anything against that bias as of now. Obviously, if something concrete happens which proves me totally wrong, then I will change my bias. I will look for sells. But for now, I am better off with targeting buys, even if they are intraday buys, even if they are day trade buys, even if they are pullback buys. I wouldn't mind that, but I am better off with them rather than targeting sells for now. Okay, obviously at some key areas, maybe at here, if we test here, maybe if we test here, we can look for some possible sells here. But for now, I would like to have one bias going into the next week. I will like to, because it means very less confusion. It will help you have a clear mind. That is exactly why, because of the yen intervention thing, because of each and everything which I just told you, I am expecting some upside in gold going into the next week, targeting this around the 4450s, 4400, something like that, before we obviously make some further trade plan. And by the way, right now we are giving all of our trade ideas as observation. We are giving all of our signals, all of our private community signals as a free observation in our public Telegram group. If you are interested in something like that, then I will drop the link in description and you can check out our public Telegram group from here. And again, just to make it clear again, this is not my buy limit, this is not my sell stop or sorry, stop loss, and this is not my take profit. This is just again for representation. I can very well, maybe depending upon the situation, maybe depending upon the CPA data and PPA data, I can very well take an entry here as well on the 4250s, or maybe I won't even take an entry. This is just for representation. It will obviously depend on how things unfold, how we see things happening. For now, based on the current circumstances, obviously I have this representation because I am planning an entry here, but it can very well change. And clearly, if there is an update, I will update that on my socials. I will update that in my public Telegram group as well, and we will take trades accordingly. Now, about about the indices. Okay, we saw a brutal profit taking in the indices as well, and this happened actually when everyone suddenly turned bullish, when the call volume was expanding, was rapiding. Meanwhile, the call volume simply means, or the call volume exploding simply means that everyone was bullish at that time. The upside trade on the indices, the upside trade on the AI hype was becoming too crowded. Okay, and at the same time, obviously, you got a very strong labor market data which pushed back the rate cut bets as well. So both of them, we got a sentimental factor and then we got a fundamental factor, and both of the factors aligned, they help to cause a simple quick intraday type of profit taking move in the indices. Now, to be very honest, to be very clear, I remain still bullish on the indices. I am not expecting a crash like this, something like that, until obviously we see a major escalation in the Middle East. Maybe the second choke point for oil supply, maybe it's Bab el Mandab, something like that. Maybe if we see that close, then obviously we can see a brutal stock market crash. But until then, I don't think so that you are going to get something like that. I am expecting only routine profit taking, only routine pullbacks in the stock market. And if we see on our MACD terminal as well, SPX still remains bullish on the higher time frame. It is just a normal profit taking move driven by obviously that sentiment, driven by obviously the strong jobs data, pushing back the rate cut bets. But overall, SPX still remains bullish. We have our pullback area around the $7,200 levels, and we have our target levels around the previous all-time highs, which is at $7,600 levels. Overall, SPX bias for the higher time frame, it still remains bullish, and I'm bullish on it as well. Now, if I try to see, tell you something else, which is going to be the put to call ratio. If you can see the put to call ratio for SPX, like you will have to see, maybe you can see that I will try to zoom in or mark something on it on the editing. But if you see the SPX put to call volume ratio is at 1.32. Now on Friday, with this pullback, with this profit taking on the SPX, until Friday or before Friday, everyone was bullish. But just with this profit taking move, with this normal profit taking move, after a like you can say after a monstrous rally, everyone suddenly turned bearish. Okay, now the side or the bearish side is crowded now. Okay, everyone is suddenly bearish. Obviously, from a day trader perspective, I'm talking about. I'm not talking about from a higher time frame perspective, from a positional trader type of perspective, or even from a swing trader type of perspective. I'm talking from a day trader type of perspective that everyone suddenly turned bearish just with this profit taking move. Overall, in my opinion, the AI hype still remains active. Our bias on MRKT is still bullish. And also, one more thing which you just can't uh, like skip. Okay, Trump is a pro stock market guy. He will do everything in his power to keep the stock market higher, to continue pushing the stock market higher. Why? Because stock market is simply the report card of Trump. He will do everything, okay, just to push the stock market higher. So I have marked 2 points of interest. One is around the 60% retracement, and the second is a little lower around that, which is around the $7,100 levels. These are my two POIs. Again, they are not buy limits. This is not my take profit. This is not my stop loss. They are just for representation. Going into the next week, based on the recent escalations which we saw in the Middle East over the weekend between Iran, Israel, Beirut, and the escalation statements exchanged between US and the Iran and Israel as well. Based on that, we can very well see some a little bit of more continuation to the downside. But overall, we remain bullish and we are looking to buy those dips. Okay, we will be looking to buy those dips going on to the next week. And one more thing, if Japan intervenes, it will very likely help the stock market as well. It will very likely help the indices as well. So you have the AI hype, you have the fact that Trump is a bullish stock market guy. Trump is a pro stock market guy. He will do everything in his power to push the stock market higher. And based on the fact that yen or Japan is likely to intervene, which will help the stock market move higher, and again, based on the fact that everyone suddenly turned bearish on the stock market, based on all of these fundamental and sentimental factors, which are obviously for intraday perspective only, we can expect a bounce in the stock market, a bounce in the SPX going into the next week. And I'm eyeing these levels, which I have marked, this one here and this one here. I'm eyeing these levels for possible buys going into the next week on the indices, specifically on the SPX. Now, one more thing, if we come here and if we see the quote report, now I will be talking a little bit about gold. And let me just see, here is the quote report. Now, if you see the quote report for gold, hedge funds have a 87% plus long exposure on gold. Do you really think they are dumb? Do you really think that last week they like there was a massive increase? Previously they had 81% longs, and now they have 87% longs. They increased their long exposure, and they decreased their short exposure by a significant amount. The net positioning increased by a significant amount. Do you really think hedge funds, institutions, central banks, they are dumb? They are buying this rally, everything in gold, and that's for a reason. Okay, and the reasons I told you already. The major reason is going to be the midterm uncertainty, and the second major reason is going to be the decline in the real yields. Okay, they all of these things, they support gold bulls aggressively, right? That is why I'm still bullish on gold. I don't see anything for the downside on gold. I still remain bullish on gold. I still remain I'm looking for downside going into the next week on USDJPY, okay, because of the likely yen intervention. I am still looking for buys on gold, and I am still bullish on the stock market as well. I'm still looking for buys, okay, going into the next week. Now, obviously, when the midterm uncertainty will start to rise, maybe by mid July, obviously you will start to see some type of a profit taking in indices, okay, because whenever there is a political uncertainty, you take all of your money out of these assets, these type of assets, and you invest all of that in gold. But right now, until then, until at least mid July, until something major happens, something like in form of a major escalation, until then we can very well see indices heading higher, okay, or at least trade in a range, okay, at least trade in a range instead of just breaking lower, okay. By the time the midterm uncertainty will start to come in the picture, or the markets will start to price in the midterm uncertainty, by that time obviously we can start to see some profit taking coming in. But until then we can very well see continued upside in the indices. I don't see any reason for a brutal crash in the indices, okay. So this was pretty much it about the indices. Now moving on to oil prices. To be very honest, now this may turn a bit into a controversial type of take, but personally, I see oil prices heading towards at least $75 per ounce, or in the best case scenario, around the $65 per ounce before the sorry, I'm saying per ounce per barrel, okay, before the next leg higher. Now, why I'm saying this, I made a post about it on X as well, but I will summarize that here quickly. The thing is that the midterms are near, okay, midterms are around the corner, the campaigns are starting, okay, and Trump can't expect to win, or the party of Trump, they can never expect to win or even build a strong position around the midterms if they are in an active war, if the inflation expectations are expected to rise, if there is expected that rate hikes will come in the picture. You can't build a strong position around the midterms with all of these narratives in the picture already. If you want, you will need to postpone this active war, you will need to bring the inflation expectations lower, and you will need to bring the rate hikes uncertainty lower as well. And how you can do that? You can do that by, now again, this may be a controversial take. I had a lot of controversy on this, around all of this take on X as well, but you can reach all of this by a short-term deal. Now, what I mean by a short-term deal is simply by signing an MOU, Memorandum of Understanding, which Iran and US right now are talking about. They are not talking about a full end to the war. They are talking about a memorandum of understanding, and that memorandum of understanding, sorry, I had to pause for a second because of the call to prayer, but never mind. That memorandum of understanding, I was talking about the memorandum of understanding, and that memorandum of understanding, it won't be a full fledged deal. Okay, it won't be a full end to the war. The memorandum of understanding, which they are talking about, simply says that there will be a 60-day ceasefire, and in that 60-day ceasefire, they will talk on sticky points like the Hormuz management and the nuclear enrichment as well. But the main point here the main point here is that in those 60 days, the Strait of Hormuz will open, and there will be free supply of oil, free passing through of vessels in those 60-day ceasefire period. And if the US achieves that, then inflation expectations will fall tumbling to the downside, the rate hike expectations will fall tumbling to the downside, and they will get a very big edge around the midterms. And obviously, that would bring the oil prices much lower as well, even near to the pre-war prices of the $65 per ounce. Now, right now, obviously, clearly, I'm not saying that we are going to reach the $65 per ounce levels, because right now there is no memorandum of understanding signed. There is still some uncertainty around it because of the strikes in Lebanon, because Iran wants to include Lebanon as well in the memorandum of understanding, and they also want their frozen funds to be released as well in the memorandum of understanding. So these are the few sticky points for the memorandum of understanding. But I believe US can take a small loss for a bigger win later. Now, again, just to be very clear, I'm not saying that the war is going to end. I believe that this war will continue running until a total destruction of one party or until a total surrender by one party. And that is very unlikely in this case. Like a total surrender by America or by Iran is very unlikely for now in this case. That is why maybe a total destruction will happen. Hopefully not, but this is what it looks like. But for now, I believe a memorandum of understanding will be reached before the midterms. Okay, there is a reason why we have not seen any major escalation since the last few weeks. Obviously, we have seen some small strikes by the America, we have seen some small strikes or response by Iran as well, but no major escalation. They are still talking, they are still exchanging messages by the mediators through Pakistan, through Turkey, through Saudi, right? They are still doing it. Okay, and there is still some hope for at least a memorandum of understanding. And it is also at the same time in the best interest of the US to get a memorandum of understanding before the midterms, right? So that is exactly why, based on this assumption and each and everything, I expect oil prices to move lower. But if not, even if there is no memorandum of understanding going to be signed, okay, still in that case, we can expect oil prices to at least technically go and test these $84 per barrel level. Or to be very honest, personally, again, I am expecting this wick fill, and I am expecting oil prices to test the 75, 76, $77 per barrel level before the next leg higher. I am not looking at this zone personally, to be very honest, but I will be keeping an eye on this zone as well for a possible reaction. Mainly, I am eyeing the $76 per barrel level. I am looking for this wick fill, and then I may look for possible longs based on the scenario at that time, based on the picture at that time. Okay, based on how everything is being formed, right? So this was pretty much it about this. Again, just repeating my quick intraday stances about the next week. I'm looking for shorts on the USDJPY going into the next week. Why? Again, because of a likely yen intervention, and at the same time, I'm looking for some buys on gold because of the everything I told you: yen intervention, midterm political uncertainty, real yields declining, right? Central bank still buying, hedge funds still buying, countries still buying, China still accumulating gold, India still accumulating gold, each and everything. I'm still looking for longs on gold around the $4,200 levels, around the $3,900 levels, or maybe even around the $50 per ounce levels, right? I'm still looking for longs, and I'm still bullish on the indices. I'm still looking for longs maybe around the $73.50, sorry, 72.80 dollar levels, or maybe around the $7,100 levels, targeting again these previous highs. Why? Because of the same thing: AI hype. Trump is a pro stock market bull until the midterm uncertainty start to comes in the picture. Until then, you can very well see indices rising, and due to the fact that everyone from a day trader type of perspective turned bearish on the stock market. Due to all of this fact, I'm still looking for longs, I'm still bullish, and at the same time, I forgot to talk about copper. I'm looking for longs on copper as well. For now, I am waiting for a kind of a deeper profit taking, kind of a test of this level around the 60%, 61.8% retracement area, and from here I will be looking for possible copper longs. Now, why I'm bullish on copper, I have talked about it multiple times on my X account, on YouTube as well, that this is simply a supply and demand trade. The supply of copper is expected to go in a deficit, and not enough supply, and the demand is continuously rising. Not enough supply is present in the markets to meet this demand, and this supply will take 5 by 15 years to meet even the current demand. Obviously, there is a lot of copper in the world, but that copper is not refined, it is not extracted. And to extract it, to refine it, it is a time taking process. It can take 5 years, 10 years, 15 years, 20 years, right? Copper is going in a deficit, and I am looking for longs on copper, some swing longs on copper. This is not going to be a day trade, it is going to be a very beautiful swing trade, and I'm looking for a test of the 61.8% retracement area to get some better entries, more optimal prices to flush out the people, flush out the late buyers, each and everything, and then we can look for possible longs on copper as well. So this was pretty much it. Just again as a reminder, the tool which I use for the quote report for each and everything, I will drop its link in the description as well. And we are sharing currently all of our trades, all of our signals, all of our private community signals free in our public Telegram group as free observation trade ideas. If you want to check them out, or if you're looking for something like that, you can check them out from the link given in description. If you have any more questions, you can let us know in the comment section, or by personally reaching to us, or by checking our website as well. All the relevant links to the information will be given in the description. This was pretty much it. Best of luck for the upcoming week.